Everybody, it's so good to have you here. What is it today? April 9th? Things are going by pretty fast. So let's start with where I start, which is an image. And I want you to start with images when you think about your investing because it cuts through the unconscious images that the noise machines want to throw up. So here we are with the S&P 500. And this, I'm using it through an ETF, SPY. So this price chart includes dividends reinvested. If you follow me and listen to what I say, doesn't mean you should follow it, but you know that I recognized before we broke out, before the blue line went above the red line, which the actual signal was March 4th. And then on March 5th, the buy would have happened. So basically, where is March? March 5th, that's the 11th. March 5th is close 277. So you would have gotten in about, if we just went with this one signal, you'd have gotten in here and you'd be up about 3.3%. So if we just went with the blue line over the red line, the signal would have been about 1 month ago. But even before we got into red light mode down here and then green light mode back in, I said, look, there's a lot of noise up here between these two blue lines. I said, there's a lot of noise up here. Some people in the technical world call that supply, meaning when the price came up to this section between these two blue lines, a lot of people came into the market, enough to turn the market around and move in the other direction. So there's enough people coming in saying, oh, it's at that price, I'm going to go ahead and get rid of my positions. So in the technical world, that's called supply. Whereas when the price was breaking below here, there was a lot of demand, right? The price didn't really didn't stay down below these two blue lines that long. So down here, there's this demand down here. And I said, well, look, we're going to have to go blue above red, and it's going to have to break above this point over here, this January 21st of 2018 point, because that was a critical turnaround point. And then when it did break above January 21st, which it broke above kind of from here to here, but it couldn't stay above. And so that section here, kind of here, is called a false breakout. So somebody, meaning me, needs to figure out how to make sure people are muted when they come on. So we know that when the price gets up here, sellers come into the market. And so that's why you see or don't see a move your 25% back into the equity market, right? I'm waiting. And I believe it makes sense because if you think about the actual difference, so if you came into the market, let's say 100% equity with just IVV, and you took your 25% out, you took it out on the 27th, so that 25% missed this whole move. That 25% missed this 15% move. So 15 percentage points times 0.25 is some number. Let's call it 4%, right? So you missed that 4%. That's the cost of being ready to step aside. Now, we didn't know that it was going to fall 20% and then go up. But now we're here on this March 5th, and the market went up 3%. So the way you want to think about this is, okay, well, if I'm not going to wait to see if it can clear this overhead supply, then I would have had 25% of my money grow an additional 3.3%, which is what, 70 basis points? If you want to round it up and say 0.75%. So really what you gave up is 0.75% of performance. So that's the cost. Now, what do you get for that, right? And what you get is, well, if it does move back down here, and we do move back down into this, then I believe that was a good expense. That was a good, like, I'll forego 0.25%. So if this blue line then goes back down here, which it did back here in 2015, 2016, you know what? Let's just see. There's enough stuff going on with other metrics, right? We, as of July 1st, So that's all of April, all of May. So in 3 months, the US will enter its longest economic expansion ever in its 243 years. So it's like, okay, I'm willing to be a little bit more cautious. And if some of you study price to earnings ratios, you could say, well, the PE ratio, and there's 30 different ways of measuring valuation. And that's one of the reasons I like just looking at price, because there's really only one way to measure price. What's the price? You can divide it by a lot of things, but price is the purest piece of data. So, you could say, gosh, the PE ratio is, 28. The last time it was 28 was 2000 and 1929. All right, so all things being equal, we put at the center of our investment universe, of our portfolio, we put at the center of it price. Price of what? Price of these 4 asset classes: stocks, fixed income, commodities, real estate. So by putting that at the center, we're kind of in this, I got some, I want to say it's negative feedback, but I got some feedback like, you shouldn't call it red light mode if you don't go 100% out. And it's like, well, read the words below red light mode, which says step out. Like, I don't want to have a yellow and an orange and an amber and a red. It's like, guys, it's 2 modes, green and red. And then read the sentence below it. So I'm not going to change it, because if it takes you 10 seconds to understand what red means, it's fine. And all things being equal, if we just had red and green, it's easier. And if you listen to these or read my words, you'll see, guys, we're in red, but we're kind of in that first step out. So I probably won't change that. And I want you to know I'm open to feedback. Like, no, it's like, so if a lot of you start saying, no, you got to have yellow and orange and amber and this, I would be more open to it. But I also know that the cleaner I keep it, the easier it will be to follow over the next 10, 20, 30 years. So here on the screen, we have this, and we're kind of in this exciting stage now. We're up here between the 2 blue lines. It's like, is the market going to break out? I don't know. I mean, the market could easily come down here and say, you know what, let's just come back down here and test the bottom blue line again. Because if you look at the screen, the bottom blue line is the February high and the March high. And, it comes back down here and touches a lot of this down here. It could touch that down here, come down here and go, you know what, actually, we're going to start recession now. So it's okay to be patient. And it's very difficult to be patient. And this is one of the things I teach in my training. And one of the things I realized with training is there's a resource cost. Like, it costs you something to take my training. It's a dollar amount, and that's resources, right? It costs you so much to build the dollar amount. And what I find with what people do with what happens after they go through training is the resource it costs them to take the training gets more than replenished at least once or twice a year for the rest of their life. But even more than that, the resource they get back is their attention. They don't have the stress or the angst or the overwhelm when it comes to their investments in their portfolio and their money and their overall net wealth, right? So that resource that you pay to get into training, it comes back literally in the return on investment of you get that dollar amount back once or twice or many, many more times a year. But what you get back more is that peace of mind. And one of my most recent clients, he goes, I didn't realize how caught up I was. Like, I heard you say for years about the big box and the pick of the month, but until I shut it all off, I didn't really get how much they owned me or how much like I was in it. So this is the S&P 500 with dividends reinvested. I want to show one more thing, guys. This is the S&P 500 index. This is just the index itself. No dividends, nothing. It's just the index. And what I want to show you with this is going to look slightly different because it does not include dividends. So if you look at this index between the 2 blue lines, you can see that the price of the index, and by the way, guys, just so you know, Most of the world follows an index without dividends reinvested. They don't follow what's called a total returns. They follow this price chart. And you can see that the price of the S&P 500 has just broken above the January 21st, 2018 line, just here, right? So it's in the cleaner air up here, right? This is the cleaner air. And so I'm willing to wait. In fact, statistically and probabilistically speaking, it's better to wait. Yes, it's up here. It's above the January, right, 21st, 2018 high, this line right there, if you can see that vertical gray. And so we're up here in the cleaner air. But guys, it's gotta break above this, because it would not surprise me at all if the price came back down here, maybe even tested these lows down here and fell 10%. There's enough unknowns. There's enough extreme valuation. There's enough instability in politics and in world economy and in trade negotiations to say, you know what, I'm in this RC for the long run. If we get in 3 months after the signal, air quotes around the signal, that's like, let's get the big picture right. Okay, so there's that. Let me do this. Let me move to the questions that got emailed in. And then if you guys have questions, please go ahead into the chat. And you can do a private chat. Like you can say whether it's to everyone or just to me. So go ahead and ask your questions here. Can be private or to everyone. So one of the questions that came in was in reference to a New York Times article about the buybacks. And I want to talk to you about this because to me, the buybacks, it's more of a distraction than anything else. And so basically the general question was, hey, RC, you know, the market's gone up because of all these companies buying back their stock. It's not going up because of, you know, basically the right reasons. It's going up because of the wrong reasons. And this whole buyback binge is approaching its 10-year anniversary. And what if the buybacks stop and then, you know, the legs are taken out from the market? So I believe that's what the article is about. I skimmed it. And so here's my point of view. I don't really care why the market's going up. I care a little bit, but look, the reason why companies are buying back their shares is because the Fed dropped rates to 0 and printed $3.5 trillion. So the federal funds rate to 0, that means companies can borrow hundreds of millions, billions of dollars. They can borrow that money. They could go build new factories. They could do research and development, but they're not. They're buying out their competitors and they're buying back their shares. That's where we are. And you can make a case whether it should or should not happen, but it's what is happening, and it has been happening for a decade. And I think it's going to continue happening because, to me, it's very clear. If you look at the screen here, this whole drop from here to here between the two blue lines, this literally was Jerome Powell doing an about face immediately. Hey, I'm going to put the federal fund rate increase on autopilot, increase 2 to 3 more times this year. And I'm going to have us continue to sell off our balance sheet autopilot. And the market started throwing up. And apparently he thinks the market matters. I think that's a huge mistake. And he changed his course, said no more rate increases. And you know what? I'm not going to keep the $500 billion sell-off of the balance sheet going on autopilot. I'm going to stop it in May. I think it's May or June. Slow it down in May, June. And I'm going to stop it completely in September. And the market rallied 22%. So cheap money is here to stay for a while. And we will be going into recession in 2019 or 2020. Like the probability of that is exceptionally high. And we know historically when the US goes in and other countries go into recessions, those countries' central banks, they cut interest rates as low as they can. And clearly this last time, and they start pumping out money through quantitative easing. So it's highly likely that's going to happen again. So cheap money, whether you think it should or should not be here, or there's a right or wrong to it, it's here for a while. And, you know, the New York Times article is interesting, right? It's like, yeah, you know, you're right. All these companies are buying all these shares. But so what? And I want you to be careful about old thinking, right? So I'll give you one example. From 1930 to mid-1950s, there was a hard and fast rule that every advisor and money person followed. Everyone followed this. And here was the rule. You only buy stocks if their yield is bigger than bonds. That's it. You only buy stocks if the yield is bigger. That's it. The only thing people are looking at. Right? And this is important because where people's attention goes matters. So this entire industrial complex called investing, right? They were not looking at appreciation at all. They only looked at what's called payout rate or yield rate. They only looked at the yield. The yield was the only thing that mattered. No one was looking at appreciation until the 1950s. All of a sudden, someone's like, well, you know, if you add in appreciation, yield doesn't matter as much. But that was and probably none of us on this call were actively investing in the 30s and the 40s and the 50s. But rules change. I mean, what if buybacks are here to stay? And just so you guys know, buybacks started in the early 1980s. Literally in the 80s, the SEC instituted this new regulation that gave corporations incentives to repurchase their own shares. So it didn't happen it didn't get onto steroids until, you know, the last decade. But there's just more incentive to buy shares back, right? With interest rates at 0 to 3%, that's just a bigger incentive. Like, I don't know, I'll just buy my shares back. And so just please be careful about what has to happen, right? What has to happen. Okay. The next question is around allocation. And I know you guys know that I do not provide financial advice on here. Right now I have my research hat on, and you're paying me to give my market observation on the markets. And I do that through this research. And I do know questions that come up a lot is, okay, well, I don't want to be 100% in stock, even though you step out of it, RC, and step back in. I know as they get older, I just want there to be more stability there. And so, you know, really what I'm hearing most is I really got to really understand how to manage my net wealth, because it's not just your investments. It's all of your wealth. And I mean, my answer, first of all, one of my answers is absolutely training transforms people's lives. The training that I have provided for Fearless Wealth. So I don't mean that to come across as the answer to everything is training, because training is not for everyone. But the amount of transformation and clarity that comes out of that is something that people notice. So there are adjustments you can make. You could just say, look, I'm never going to have more than 80% of my money in the stock market. Like, you could just make an allocation, say, I'll just do 80 in stock and 20 in a non-stock asset. So there's ways to go about to lower the price volatility. Absolutely. Okay, one more question. I don't see anyone texted any or chat in any more questions, and so after this, I will then. With this question, I think I'll be able to answer a lot of other questions too. So one of the things that I'm doing is I'm redesigning the membership site. And I'm redesigning it in a way where things are just super clear and oh my gosh, I know exactly what to do. It's going to be kind of more curation as much it is going to be like model portfolio. And what I mean by that is, as you guys know, the thing that sits at the center of my investment universe is these 4 asset classes: stocks, fixed income, commodity, and real estate. And so the first question that I believe everyone has to get answered is, okay, 93.6% of all variation in performance comes down to how you allocate your money to those asset classes. So, and we know that one asset class, stocks, that one beats the other 3 hands down over longer periods of time, and it's in the winning position 78% of the time. So the question I have to get answered first is what's that asset, that intermarket, those 4 assets, what are they telling me? That's the first thing, because that matters more than anything else. But then what I also want to add below that is, okay, well, look, stock, international versus US domestic, because that's a fight that goes on. And you could be living in Switzerland or the UK or Singapore or China, and you can still, most of those countries still have an international fund. So I want to show you kind of like arm wrestles, well, what's beating international US domestic? Or of the 11 major sectors of the stock market, how are they ranked? And one of the problems I run into, and I don't know if the word problem is the right word, but one of the things I run into is if I say utilities is doing well, here's an absolute price chart of utilities. And it's looking like what you want your price charts to look like, what you own to look like, right? It's going up and to the right. But it doesn't mean it's always going to be the lead sector. It won't always be the lead sector. And so I don't necessarily want to be in the position of saying, well, maybe some of you can handle a different sector that has more price volatility to both directions, right? So maybe consumer discretionary is something that for some of you is better positioned. So I want to get the membership site to be like, look, if price volatility is not a problem, but if something you're noticing, maybe you're, per the question I had just before, I'm 65 now, I'm not working. Maybe it makes sense for you to have XLU, which is still going up and to the right. Or you might say, but to another one of you, it may be the real estate sector of the stock market that is still going up to the right, but it's outperforming. And so if you look at the screen here, I'll do a couple of different time frames. If you look at, let's just see if I can get to the right date here. Can I get to, if you look at the screen, this is basically this year. And I just threw up 5, not randomly, but here's 5 sectors. Here's technology, up 23% this year. Right below it is discretionary, up 19.5. Below that is utilities, only, air quotes, up 9.8%. Right below that is gold miners, GDX, up 7.6%. And below that is healthcare. So we know this year, 3 months into the year, these are some of the best sectors, or best sector technology. And these are the major ones. We can go subsector, like a subsector of healthcare is biotech. And here's consumer discretionary. All right, and so the next thing I could say is, well, how did they do since the peak? Right, so we know on September 26th, the market peaked of last year. So now we have about 6 months of data. We can say, what's still doing well? Okay, well now the leading sector is precious metal mining shares, up 24%. Right now we used a different measurement. And the next one down is utilities. So I just changed the time frame from this year to Okay, at the last market peak, which was September 26th, what has done well? And the answer is, it's clear. Utilities are up 14% and precious metal mining shares are up 24%. I'm rounding here, guys. Now you could say, RC, why did you not tell us to get into GDX? So this gets back to how curated, or how do I want to best position information to you? And just so you know, guys, if you're open to me talking to you or having one of my employees talk to you, like, what are you looking for? Like, when you log into the membership site, what do you want to know immediately? What do you want to see? So every time you pay your annual subscription, you go, I'm so excited to pay this, because every time I log in, this is exactly. So if you could just email me, rc@fearlesswealth, say, look, I'll let one of your employees ask me for 5 or 10 minutes exactly what I'd want to see. We'd love to know. So the reason why I don't have GDX in there is because GDX is not a sector. It's a sub sector, right? The main asset is commodities. And then a sub class of commodities is metals. And then a sub is precious metals. So it's 3, subs below the actual thing, which means there'll be more price volatility. Then down here, you do have technology up 3%. So technology is in the top 3 of the 5. Then you have discretionary, and down here you have healthcare. So you want to look at different timeframes, be like, where's the strength? And you can start to see, this has the strength here, this has the strength here. Now, one thing I'm just noticing, I want to put in here, let me just put in here XLRE, which is real estate. Let me just do this again, and I'll go in reverse. So I'll go back to that September 26th. So still, precious metal mining shares are up. Now, I want to let you know that one of the canaries in the coal mine is precious metals, meaning people move into that when they're concerned about the future. So the fact that even though it's gone sideways, it's up 7% this year, but you can see here it's gone sideways for maybe 2 or 3 months. It's holding its own, right? This black line right here is real estate. So real estate is up 15%. Right below that should be utilities. So if we went back to the beginning of the year and we did the same thing, but we now have utilities in, let me see if I can get to, hold on, 68 days. You can see technology. So here's real estate. So real estate has done well since the peak of September 26th and this year. So that's one of those just like, okay, that's good. So here's my dilemma. I don't want to be changing out asset classes, question number 2, too fast. Because ultimately, XLU is doing well. It's going up and to the right. It's not falling absolute basis. But there are other sectors that are clearly stronger. And so I think the answer is I provide that information in the membership site and just go, look, here's the strongest one over this and this period. And I still like XLV. XLV is one of them, and you can see what I just showed you. XLV is underperforming, but I look at XLV here and see up and to the right, and I see it consolidating here. It's consolidating, and I'm okay owning something that's consolidating, right? It's not falling, right? It's not falling. There's this line here that it's kind of standing below, but sideways is not down. And I understand other things are going up right now, and that's okay. I don't believe you should always be in the strongest asset that month or even that quarter, because what's going to happen is there's going to be a lot of trading. I believe that of the 11 main sectors, if your money's allocated to the top 3 or 4, generally speaking, then you're going to have less activity and you're going to have better returns. So the question that, Guy, you actually sent in was, I'm finding biotech and consumer discretionary investments doing better than healthcare, which is true. Like, they are doing better. If you look at, here's XBI. XBI is biotech. And if you look at biotech here, big correction, right? This fell, XBI fell 35%. That is a huge fall. Considering the market fell 20% during the same time period, it fell 75% more than the market did. And if you take this and divide it by SPY, you can also see that it stopped outperforming back here in June. But that wasn't your question. Your question was kind of like, hey, it's doing better than healthcare. So if I take XBI and I divide it by healthcare, you can see the same thing. XBI underperformed healthcare until about December, peaked down here. But XBI, the blue line has not gotten above the red line yet. So I like to see that. I like to see those two things. And it hasn't happened yet. It may happen. So I think if I provide more of a curated membership site where it's super clear, I know, I see the dashboard RC, I completely get what's going on, and there's still that model portfolio, I think it might provide that for you guys. And again, I'd love for any of you to step up who are like, yeah, have one of my research people call you and be like, what exactly do you want to see when you log in? You can absolutely have feedback into what the new design is going to look like, which is coming up soon. So I believe I answered the questions that were sent in. Thank you guys for being in my world. Oh, the one thing I do want to show you, IEF is one of those answers. And, you know, IEF is interesting. It's 7 to 10 year treasuries. Let me zoom out a little bit here. Just started raining. So this is dividends included. And we know that once IEF gets above the two blue lines, kind of that phase, we know either it's going to have to turn around because a lot of supply, a lot of people come in and sell it, or it's going to break higher. And the fact that it's broken up into this area, which is a bigger range, but still it's only 2.5%. You know, last time it got turned around here between these two blue lines. But we're kind of up here like, okay, is it going to break higher? And so we have to watch. We know the total bond market index fund, BND, we know that has fully broken out into the upside. Again, this includes dividends. This is like the total returns bond market. But it's broken out and heading up and to the right. So that also gives me pause to, we allow it to be okay to just be patient. And you're gonna underperform sometimes. You don't wanna necessarily own XLU for the next decade. That's not what I'm saying, right? Here's the last 6.5 years just by itself. Though if you did, it would have been okay. And this gets back to maybe the new redesign on the membership site. Like, hey, a lower volatile, but still trending higher, you know, choice could be this. And if some of you are noticing you want that clarity, I'd strongly suggest you to set up a strategy call with me and say, you know, what would it look like for me, or where is that biggest leak in my portfolio, or, you know, what would it look like if you manage the money? Those are you know, offers to you. So thank you guys for being in my world. I'll hit the pause button. I will get this uploaded to the membership site. And when things change, I'll end with the S&P 500, SPY here. And I'll actually I'll zoom way in, or more in than I usually do. And, you know, we're up here right now. And so we're in the cleaner air, but we're not out of the smoke yet, or we're nearing the edge of the forest, but we're still in it. And it's the same thing if you really look at the index, which is a more followed price chart. You can see that the price just got up here to the cleaner air. Will it stay? Will it continue to get stronger and get stronger? And we're kind of in an interesting point because earnings season's going to start up again. And so we get to see if the market wants to go higher with all the new earnings news. And you know it's good news if the market goes higher, and you know it's bad news if the market goes lower. So regardless of the words that Intel and IBM and Whole Foods, actually there's no Whole Foods anymore, and Amazon and Broadcom, which I guess is Aviago now, more than the words are what happens to the price when those words come out. So thank you for being in my world. I appreciate you guys, your attention, your energy, and I look forward to continuing to work harder to get you the best experience of what you want when you log into the membership site and when you come to these bonus calls. So thank you guys, and I'll speak to you next month. All right, take care.